Hello, welcome to another video on our channel called Cambio Descomplicado. As I promised yesterday on Instagram, here on YouTube, today we're releasing a really interesting video. You can't miss it. We're going to talk about pricing at the trading desk, how it works at the foreign exchange desk, how to contract a transaction, how to calculate the spread in pips and bips. If you stay until the end, you won't regret it. Stick with me until the end. You're going to like it, all right? Shall we get started with today's lesson? All right, let's get into uncomplicated foreign exchange. In the previous video, we talked about parity, currency, type A and type B, cross rates, rate formation, convertible and non-convertible currencies. Today, we're on the third video of this series called Uncomplicating Foreign Exchange. And I'm going to start with the following question. What is the famous spot rate? We hear so much about the spot rate, but what exactly is the spot rate, Marcela? Well, the spot rate is the current rate. It's a rate that reflects a transaction that will begin today. In the case of spot foreign exchange, it represents the price for settlement within up to 2 days. Therefore, a spot foreign exchange contract is one in which the exchange of currencies and settlement are carried out within 2 business days. So, how do you know when you can settle a foreign exchange contract? When the actual exchange of the real and the foreign currency is in fact delivered. If it's a sale, I have to receive reais from the client. The bank receives reais from the client to send the foreign currency abroad. At the moment the bank sends the foreign currency abroad, the contract will be settled. With the central bank, once the payment order has been sent abroad, the transaction is then considered settled, okay? Within 48 hours at most. Now we have the forward exchange contract. The forward exchange contract is the one in which the actual exchange of currencies and settlement occur after more than 2 business days, which we call D+N. In other words, there are 360-day forward exchange contracts and contracts with other terms as well. Also 360 days. That's what I mean. Now, I want to talk to you a bit about how the rate is formed, how it works in the mind of the trader at the bank, the one who is going to execute the transaction for the companies. He has a spot rate, which is his cost rate, right? And this rate, we call it the D2D2 rate. Notice here on the screen that since you have a 48-hour period to settle a transaction, you need to take this premise into account, this matrix, where the reais can be delivered on the same day on D1 or on D2. Likewise, the currency can also be delivered on D0, D1, or D2. Obviously, there's a whole calculation formula we use here, but the rate, the spot rate, its references for delivery of reais on D2 and currency on D2. Any change to this parameter at the time of closing the exchange will affect the cost price of the rate. For example, here it's 5.18 for delivery of reais on D2 and currency on D2. In other words, I, as the bank, receive the client's reais on D2, and I also send D2 to the foreign country. Suppose the transaction is closed on a Friday. By Tuesday, I should receive the reais and also send the dollars abroad, right? The problem is that it doesn't always work that way. And usually it really doesn't, right? And I'll explain why later. But suppose the client who is going to close a foreign exchange deal wants to deliver the reais on D0. So they're in this row here, look. Reais on D0. This means they're closing on Friday in my example and already want to deliver the reais to the bank on D0. But they don't mind if the dollars are sent abroad on the same day. It can be on D2, so reais on D0 with currency on D2. It's right here, which means I have to take this spot rate and make an adjustment to it. Subtract 2 days of CDI. Why, Marcelo? Because the bank will keep your funds for 2 days and will invest that money. It's only fair to share that with you. Or start from a cost rate that takes into account the discount of 2 days of CDI. And it also works like this. For example, if it were reais D0, currency D0, it would be here, right? It would also be 2 days of CDI, but the bank may also have the prerogative to charge 2 days of an international rate. Because you are asking to deliver foreign currency before day 2, therefore the bank will have to send the dollars abroad. Before D2, behind this operation, there may be an interbank transaction where the bank receiving your reais sells or actually buys the currency on the market and receives the dollars on D2, or it may use its own cash reserves. The fact is it has up to 2 business days to settle this transaction. And that's because you can even request to settle on D1 or D0. Any change that deviates from D2, D2 simply results in a change in the cost of the rate. And what are the criteria for changing this rate? For the domestic part, we use the CDI and CTIP, which since the Selic is at 2%, it's usually the CDI and CTIP that we use here. In this example, 1.90% per year. And for international, we use LIBOR for now, although that's about to change, but for now it's still LIBOR. So in this example, LIBOR would be at 0.446388% per year. These are the two rates we use to make any adjustments to the cost rate. So the rate used for CDI on a daily basis is the CDI CTIP rate and not the Selic, as I mentioned, which is the target rate currently at 2%. Just so you know, we need to understand where it comes from. Selic is the special system for settlement and custody. What is that, Marcelo? It's where the government bonds traded by banks are registered and traded. The Selic rate target is the direct parameter used by banks to determine the cost of money in one-day overnight interbank operations backed by government bonds. CTIP, on the other hand, is the Central Depository and Financial Settlement System for private securities, which is a system very similar to Selic, but operates with private securities. And what about the CDI? The CDI is the Interbank Deposit Certificate, which I'll talk about on the next slide. The day over rate, or CDI over, is obtained by calculating the weighted average of all rates and transactions carried out in CTIP between institutions from different conglomerates. Marcelo, do I need to know all of this? No, not this part. Usually the trader at the exchange desk or the brokerage knows this. He's the one who will give you a price. Now, what price is he going to give you for the dollar? Is it this one here in this example, 5.18? No, he starts from this price to add the bank's or financial institution's profit, whether it's for buying or selling. But he has to adjust this from the moment you decide to do something different from D2 and D2. By the way, D2 and D2, it's not very advisable because the bank needs to wait for the re-AIs to be confirmed in the account before sending dollars or another currency abroad. If it's Japanese yen, for example, you can't even do it because you need at least 1 day to make the payment, right? So you already have to do it in D1. So this is just for you to understand the concept of a spot rate, okay? The formation of the cost rate. Once the trader has the cost rate, they will add the spread. What is the spread? How do you calculate the spread and an exchange rate? The spread, folks, is the difference between the cost rate and the final rate for the client. The bank, the financial institution, is not a charity. Their profit comes from, they buy this currency and sell it to you. So the spread represents how much a financial institution is earning financially in the operation of buying or selling foreign currencies. How does a trader at the foreign exchange desk, after arriving at the adjusted cost rate, as I mentioned in the previous slide, add the spread to their exchange rate? Let's go. The spread can be calculated as a percentage over the rate. But first, it's important to define what basis points are. Don't confuse percentage with BPS, which stands for basis points. For example, a rate that went up from 10% to 11%, what happened to it? The percentage change was 10%, but in basis points, and get used to this term, we call it 100 basis points. We say it had an increase of 100 basis points. Therefore, 1% is equal to 100 basis points, so you can start getting used to the language of the currency market. For example, from 5.36% to 5.40%, we say there was an increase of 4 basis points, okay? Basis points of increase. Let's look at an example. Percentage spread. Suppose you're about to close a payment operation for an import of $500,000. This is a sale operation. Remember, I explained this in previous videos. A buy or sell operation. Always from the bank's perspective, the bank is selling you a foreign currency. So for a $500,000 operation, suppose the cost rate, the trader got a cost of 5.20. That's the price without the bank making any profit. So the cost amount would be 2,600,000 Rs. Then the trader receives the information that the spread the bank wants for that operation is 0.30% or 30 basis points. Calculation of the final rate. You take the 520, multiply by 1.0030 because I'm adding the 30 basis points, and you get the final rate of 5.2156. This rate is the rate for the client, not this one. This is the cost rate. The rate for the client has an increase of 0.30%. Therefore, $500,000 times 5.2156 equals 2,607,800. What is the bank's profit? 7,800 Ries. Another way to calculate it is to take the value in Ries and multiply it by 0.30%. You will arrive at a profit of 7,800 for the bank or for whoever sold the foreign currency. Now let's do a calculation, an example of a purchase. Now the dollars have arrived from abroad. The bank notified you. Your company is going to close the exchange. The cost rate is also 5.20. Cost value is 5,200,000 for an amount of $1 million. The intended spread is 0.40 in this case, or 40 basis points. The calculation of the final rate, therefore, is 5.20 divided by 1.0040, which gives 5.1792. This is the rate for the client. Marcelo, is it lower than 5.20? Yes. In a purchase, you decrease it. In a sale, the bank charges, the rate goes up. In a purchase, it decreases. So the bank will deliver 5,179,200 to the company. Since the cost was based on the rate of 5.20, the profit was 20,800 Ries in this operation. Of course, there are much smaller spreads than this. I'm just using a larger spread as an example to make it more illustrative, okay? So as proof, if you take 5,200,000 and multiply it by 0.40%, which is a huge spread, the bank is earning 20,800 Ries in this operation. Now, there is also a spread that can be calculated in points, which we call pips, points in percentage. A PP is equivalent to a variation of 0.01% or 1/100th of 1%. In financial language, this value is called a basis point. A basis point, therefore, is equal to 1/100th of 1%, or in other words, 0.01%. This percentage in absolute terms corresponds to 1/10,000th. Marcelo, I don't understand anything. This is too complicated. So let's look at some examples and then it will become much clearer for you. For example, the transaction amount is $800,000. The bank is selling dollars. You go there and need to send $800,000 to any country like the United States. Cost rate 5.2010. This is the trader's cost rate. The amount in raise at the cost rate is 4,160,800. So if the bank gave this rate, the bank wouldn't make any profit on this transaction. Now, instead of talking in percentages, the trader is told that they need to make 15 pips on this transaction. Or they already have a relationship and know that this client usually agrees to pay 15 pips as previously arranged. The adjusted rate, therefore, see, 5.10 and 20 becomes 5.20 and 25. The rate went up by 15 pips here. If you take the 800,000 and multiply it by 5, 0.2025, which is the final rate for the client, you get a value of 4,162,000. The institution's profit, therefore, is 1,200. If you take the 800,000 and multiply it by 0.0015, you'll arrive at the same way of calculating the revenue from this operation. Now let's look at the example of spread in basis points, PIPs, this time for a purchase. Transaction amount, $600,000, cost rate, 5.2010. Remember, the cost is the rate the bank would not have earned if it had done the transaction at that rate. What is the bank going to do? It will. The amount in Ries at the cost rate would be 3,120,600. The spread in this case is 5 pips. It's a company that's more rate sensitive. It's hard to open up a spread, right? That's the kind of language the market uses. So the company, sometimes there are companies that basically have real banks inside them, track prices very closely. And for this company, only 5 pips fit. The adjusted rate would be 5.2005. See, the cost was 5.2010. To calculate the final rate, you take 600,000 times 5.2005, and you'll get a value in Ries of 3,120,300. The financial institution's profit in this operation was only 300 Ries. As proof, if you take 600,000 and multiply by 0.0005, you'll get to 300 Ries as well. All right? Well, folks, in the next video, we're going to start by talking about nominal rate and real rate. Purchasing power parity, do you know what that is? So don't miss the next video, okay? It was a pleasure to be with you in another video on our YouTube channel called Cambio Descomplicado. To everyone on Instagram as well, I ask you to keep following me and share it too, all right? Thank you so much for watching, for your support, a big hug, and see you next time.